So the market keeps heading lower and lower and lower and lower. And in today's video, I'm going to share with you a little insight regarding some of the moves and pullbacks that we've had as far as trading goes from a trading perspective, because a lot of people, that show me some videos here recently and they're saying, well, what do you think about this? What do you think about that? They're really trying to digest the news. They're trying to digest the information that's coming in. And unfortunately, from a trading perspective, that's very difficult because you're going to get a lot of data that comes in and you're going to try to figure out, well, what do you do with this data? And I always like to say, as a human, when you have the color red, and I show people the color red, like even on this screen right now, there's different colors for the arrows. And then right here, we've got a pink to kind of a darker pink gradient. Like which one is a true red to you? So what you really see is that when you pull out shades of red, other people are going to choose different things. And in trading, it's not much different. What you'll see is everybody's got an opinion. Everybody's got an idea of what's going to happen, whether it's going to be China or US, who's going to fold first, who's going to do well, who's going to come out on top. How is this all going to play out? We don't know. But the thing is that in your business, in the line of trading, so approaching it from a trading perspective, it's not about that. It's about managing your capital and managing the risk. And when you start seeing big candlesticks, when you start seeing markets move fast, 400 points in a single day, it's time to lighten the load. It's time to reduce your deltas, reduce your exposure. And that's kind of some of the things I'm going to chat with you about in this video. I'm going to talk a little bit about the risks, the things to watch out and expect as markets go kind of crazy and haywire. As far as all of these things go, it's not about being political one way or the other, because that's not my role or my game plan. For me, it's about looking at the trades, looking at the environment, the conditions, and what is it that you can do from a profitability standpoint, from a defense standpoint, what to expect, what can happen, and some of the tools maybe in your toolbox that you might be lacking. So for example, if you're trying to, put a hole in your wall in order to put an outlet in, you could use kind of a knife, or you could use like a Dremel tool. So you could do it a little bit faster. And the thing is sometimes some tools are better than others for the job or task. So we'll get into that and give you a little insight. Now, if you're brand new here, I'm Sasha, the options coach. I've been teaching people to trade options over the last decade, a lot of one-on-one sessions to a lot of classes, courses, and many of those kinds of things. And if you have some questions, do reach out on the comments down below. Send me a note. The best way is probably on the website. You can text me. There's a phone number on our website. So reach out, get in touch if you need some help specifically, or if you're interested in taking some of our classes. Anyway, let me get started with you and give you a little insight and perspective here in the market case. So here, what we've had recently, and this is just looking at the SPX, we've had a lot of wild days and candles. So we kind of started slow, and then we rolling over a little bit on the moving average. And then we did a little pop, and then we roll over further. And then here is the, your mega tariff day announcement here that comes in, the market opens, and we kind of whip around a little bit. So what you can see right now is we've been having wild swings. So one of the things to watch when you get swings like this, let's go to about a 30-minute. When you get swings like this that are really wild, even today we opened up and then we rolled over. When you start seeing these kinds of things, it's important that you realize that, hey, you can trade lighter. So if you're doing trades and you're doing kind of just stocks on its own, then you can also trade lighter. Because, for example, in a normal market move, let's say a normal market SPX handles. Okay, so you could pick a stock if you want, but let's just use a normal day-to-day move. Let's say in a normal day-to-day move, the stock SPX might move 20 to 30 handles or points. Okay, in this market condition, we went from 2240 to basically 4,925. So we had almost a 300-point range. So what that means is that in the past, if you were doing 10 shares, not that you can do shares on the SPX, actually you'd be doing option contracts, but let's say you're trading 10 deltas or so. That movement here on a 20-point move on average is a $200 move plus or minus, maybe $300. However, now if you had those same 10 shares, that move would now be $3,000 plus or minus. So you're actually moving almost 10 times the speed. So what does that actually mean? It actually means if you're doing day trading or that kind of thing, you could actually go to 1/10 the size, smaller size, and still keep the risk at hand very similar. So think about it. You can actually use less money because the movements are more extreme or more dramatic. So, watch the capital sizing and positioning. Now, I know you can't buy the S&P, but what you can do is, like, let's say we look at a stock like Apple, the movements are much more significant. They're more dramatic. Even in one of these cases, you did have a move to the upside and then you rolled over, right? So you do have those movements. Like from here, you have maybe a 178 that goes to a 190. So even that swing, it's about 10 points if you held overnight. If you didn't, you'd go from somewhere around this area, about 178 to 182. That's still a 4-point move in the stock with an intraday move. So that is amazing or phenomenal. But you have to really recognize where you are, and from a strategy basis. I always say from a trading concept, you got to know a few different things. Your method, your strategy, and everybody's a little different. You got to have your money management, and you got to have your mindset. And if you want this worksheet, just let me know. I'll send it to you absolutely free. Just mention it. You can mention it in the comments. I might be able to reach you out there. The best way is also on the website, live chat, or email, text message. Let me know and I'll send it to you. But what happens is that everybody's got a different skill set. So for you, in your case, if you're at the point where you are doing more, let's just say just only stocks, well, you've got a limited toolbox. You can only go up, or if you can short, you are shorting. So it's either up or down. Once you get into the world of options, you actually get a lot more leeway and things you can actually do. So you can get into vertical spreads, you can get into at the money ones, you can get to out of the money ones, you can do calendars, diagonals, butterflies. I mean, there's many more tools in your toolbox that you actually have, making profits or income, or even just hedging or defending positions when things go against you. So let's say you own shares of stock. If you have shares of stock, well, if you're doing things for long investment, you have 100 shares. Well, now you have 100 delta. The problem with this is with 100 delta, you are making or losing $100 for every dollar move up. And if we know all of a sudden that what we've got right now is a bigger move on a day-to-day basis, well, now we're losing $100 every time that stock goes down $1. That's a problem. So with an option, what we can do is start hedging things off and kind of cushioning those things. Now, doing things and hedging things off, again, depends on your skill set and what you can do. We've covered a lot of concept in one of our classes, the crash-proof trading. Actually, this was done about a month ago. So we did a lot of topics in there. Now, when you're looking at something like that, like let's say I have these 530 shares of AT&T. And I still have them. They're down to 1.64%, and I'm down $233 kind of today, you could say, in this IRA fake portfolio. So what we can do here with AT&T is if you look at the way that this behaves, like the purchase of this stock was around $18.71. So this was a little while back, and this stock was continuing to trend higher. But here's the thing: I'm still traveling at 530 delta. When you're traveling at this speed, what is it that you could do that if you're worried or concerned about the market? Well, for a lot of people, if they know how to do it, they could liquidate part or half. That's probably the easiest approach. And that means if it goes down $1, you're only losing, let's say if I cut that to half from 500 to about 250, then I'd be losing 250 on the way down. Now that also means I only make 250 on the way up, but I'm hedging off, waiting for the storm to kind of calm down. And in general, usually this too shall pass, right? The storm will subside, and, just like other recessions, economies, those kinds of things. Now, that might mean, through all of this, the allies or people we used to call friends, like in Canada, Greenland, European Union, all of these different countries, it might mean they don't really trust us too much through all of this process for the next decade or even 50 years. But the thing is that from a market perspective, you might see more calm markets coming up in the future. Again, you don't know when, but let's just say even if we go down to, let's call it, I think the level I was looking at was, somewhere around here, 4,800, or even let's say 4,100, or at kind of a worser case, maybe 3,700. Even if you get there and you get some stability by then, well, it's going to shake out a lot of people. That's first off. But now that you have stability, now you're back into more normal, regular trading world because everything's kind of reset. It's like, okay, now this is the world we live in, right? It's like, hey, this is the economic reality. And at that point, then the fear subsides. Yes, everything's repriced, but the fear does subside. And then the market conditions, the whipsaw, the huge bars and the moves that you'll have will be much more limited. So anyway, but for this point, until then, what we can do is look at cutting our delta. So here is our delta of 530. One of the simplest things is if you own shares of stock, you could say, okay, well, I'm going to go, let's just start defending it around 45 days. I could start selling some deltas at about 28 and saying, I'm willing to get rid of that stock at 28. And we'd be selling a call. And when we sell a call, we add a negative 32 delta. So think about it. If I have 530 shares, okay, which is 530 delta, and then I go in and add a negative 32, it's going to get me under the 500 range of deltas. And if I do more contracts, let's say I sell 5 of them because I got 500 shares, my delta is now 367. So what this does is really now when the stock sells off, I make, I lose only 367 instead of losing $530, which is a huge bonus. Yes, I'm still losing. Yes, I would still keep losing money if it goes down, but at a slower pace. Imagine if I can do even more. Let's say I can go to 27 here. And now my delta is 303. Can I go lower? Yes, you actually can because I bought this stock at 18. So if I bought it at 18, I could actually go, let's say I go to 20. I say, I'm willing to sell that stock at 20. I'm willing to do that. So now if the stock keeps selling off and it gets to 22, okay, yes, I still sell it at 20, but here's what happens. When you sell a bunch of this premium, you're actually collecting $550 per contract times 5, which would bring in an extra $2,750. So overall, right now, this position's profitable $4,000, but I can bring in another about $2,750. So it would cushion that blow and loss. Yes, I have to sell the shares at 20 here, but you're bringing in the extra cushion or capital from it. In other words, what I'm really more concerned about is the delta, because if it keeps going up, I'm still making money, but I'm only traveling at 77 miles an hour, as I like to say. I'm only moving up or going to make now $77 per dollar move up instead of the 530. What did I do? You basically tapped on the brakes, okay? If you really want to think about it from a market perspective, you're tapping on the brakes. When this thing starts going down, I'm losing 530. If it goes up, I'm making 530. I've got speed, okay? But if I tap on the brakes, I'm cutting that speed and letting the market kind of digest, settle, do what it needs to do. And then I could increase the speed later when the conditions are more favorable. This gives me an opportunity to just wait and see a little bit rather than getting all crazy and wild up about these fluctuations. And you could wait, a month, 2 months, you could do these contracts further out. But this is just looking at selling covered calls. That's kind of a basic level. If you know how to do that, if you know how to understand that, that's fine. There's nothing wrong with that. If you're more in a margin account, believe it or not, you can actually oversell. And some people are going to say, oh, that's bad. That's not a covered call. It's true. It's not. But when you get more advanced, it's actually more about cutting deltas and less so much about being precise, 500 shares to 5 contracts. It's actually more about managing the different contracts at different spots. So I could actually go in and say, okay, I'm going to sell a few contracts at 25. I'm going to sell some more maybe at 27, and I might sell some more at 28. And what this could do actually is convert me into, like if the market keeps going down, now I'm only at a delta of 39. And if I add this extra one more, I'm at a -6. So if the market even keeps selling off, or in this case, this stock, I'm actually not losing much of anything because my delta's flatline. Now, if it starts ripping higher and whips up, this is the tail, the 2 coins, the 2 issues that you could have, right? Or the opposite side, the sword is a double-edged sword. So what you've got is the other problem that if it whips up, now you're actually going to be losing money on the upside because you've sold a lot of insurance against your position or sold a lot of calls against that position. You've cut your delta too much where you've got no exposure. I'd say be a little careful in the conditions like this because the market is a little, from a temporary basis, a little more oversold for the short term. right? For the long term, I mean, it could still keep going down longer. But for the short and medium term, it could be a little oversold. We could be due for a bounce or some kind of bounce at some point, maybe not this week. It could be next week or a couple of weeks from now, but you're kind of in that zone or area for at least a temporary bounce. And even today, we had a little bit of a pop and then kind of a rollover effect. So my point here is that we can cut deltas, and you need to learn to manage those deltas, because now what you've got is, okay, what delta do I want to travel? And you could say, well, I'll travel at, a 69 delta instead of 530. And this is where you can be a little more peaceful with what's going on and what's happening, is that if you're dealing with stock, you could start in this case. You might also wonder, well, can't I just buy puts? You can. The problem with that is now with volatility levels very high, what you've got is a more expensive put position that you can go in and purchase. So let's say I buy 500 of these at a certain price, it's going to cost me $500. Now, one way to offset that cost is sell 5 contracts at, let's go to about 28, and we can sell 5 contracts, well, let's do 27 right here. So what I can do is buy 5 puts for $97 a piece. That cost me about $500. And then I can sell the stock at 27, which is a buck higher here, for 98. So again, $500. And what that does is cancel both of these two out together, okay, with a net difference of about, what is it? Net difference, a couple bucks, $5. So you're not making anything on the call side, but you're not losing anything on the put side. But what it does is the put side, what it's going to do is give you that protection and limit your downside losses. So in this case, I'd actually come out with a profit because my downside would be limited. And then my upside, I would cap it. But now if the stock just kind of stands still, or if it pulls back and comes back to where it was, what happens is that I don't lose any money on the puts, but I don't make any money on the calls. I kind of break even between the two contracts, and the stock is at the same spot. Now, if the stock goes up, what happens is I lose money on the puts. I still gain money on the calls. So again, none of that, but I get to make the movement in the stock price to that upper level where I'm kind of in a way forced to sell the stock at 27. Could you get out of it early? Yeah, but that's a whole different discussion. We talked about this strategy actually once in one of my classes, zero cost put buying strategy, where we got into it pretty heavy, managing some of these positions and kind of neutralizing the delta and the upper side, the downside, because it's a good way to buy insurance at a zero cost or cheap way, where you're offsetting the purchase of insurance with the cost of that with the calls that you sell, really known as a collar strategy. So anyways, those are a couple of simple techniques that you can kind of start out with and start looking at as you have into some tariff chaos. I mean, we can do a full multi-day session on this really because of the complexity of things, but this is what we do and cover things in a lot of different classes here that we've done recently. So anyways, I hope this helps. It gives you a little insight as far as the YouTube world goes, or the Facebook world, wherever you're watching this, gives you a little perspective of what you can do, how you can look at things, because obviously it really comes down to just more managing the delta and the position that you have for most people, because that is where they're more exposed. They're exposed to the price risk. If you're doing calendars, butterfly spreads, or iron condors, you might be also exposed there, but you also might have some too much short vega or too much positive vega. You might have other risks involved in there if you're doing more complex trades. But for the regular person, what's really happening is when you have a lot of shares, most people are bullish and you don't have a lot of negativity. You don't have a lot of even things like a reverse wheel. This is something that we've covered in, again, one of our other classes, where a lot of people will do the wheel, the standard wheel. You buy 100 shares, sell this. You sell the call against it, and you repeat that process. But you can actually do the reverse wheel, where what we do is we sell 100 shares first, then we sell a put against it. So it looks very similar. So if we've got let me go to, let's just call Apple for a minute. For a lot of people, when they do the wheel, and we'll just go right here to the 180, they buy a covered stock. This is what it looks like, okay? And you're buying the shares, and then you sell the call against it. But what you can actually do is, instead of buying the shares, you can actually dump the shares first, okay? We'll dump 100 shares. And then what we do is we sell a put against it. So this allows us to neutralize a lot of our positions if they keep heading higher. And having a few of these in your portfolio, reverse wheels, are really nice. So instead of just having the wheel where you might have, 6 positions and they're all bullish, well, they're all going to be positive delta. If you had some reverse wheel concepts where instead of having 6 wheels, you could have 4 wheels and maybe 2 to 3 reverse wheels, you're still more bullish, but this offsets the balance equation in order to recalibrate things if things go down against you. Now you've got more negative delta in the mix, right? To hedge off that portfolio, to hedge off that. And what this does is when you're short 100 shares, right? You want the stock to go down because you sold it first, then you buy it back at a lower price. But if you don't, and if the stock heads higher, you're collecting the premium by selling the put. But if it does go lower, you will get the stock put to you, which is what you want because you're negative 100 shares. Again, it's not for somebody who's kind of new to trading or new to investing. It's a little more intermediate, advanced beginner concept, depending on what scale you're looking at. But, as an advanced beginner, this is one way to start looking at it. As you get into verticals and those kinds of things, you might have already seen these things. But if not, this is another thing that you could look at. So anyways, truly appreciate you joining me. If you have questions, reach out. If you want to check out some of our classes, let me know. Go to our website. There's a lot of great content, information, knowledge. Sign up for a class, check it out. You can get access to a bunch of our material, and hope to join you and work with you at some point in the future. Anyways, other than that, enjoy your evening, enjoy the week. Remember, there's more to life than money. Live your life abundantly, enjoy the little things in there. The market's always going to be there long before you and me are, way past, my lifetime. So anyways, make the most of it. We've got a lot of volatility here. It whips around. Keep your position size small and reduce your delta, and that should keep you more out of trouble or give you a peace of mind. So thanks again, and I will see you in the next video.